Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Coming up on the show today, we're looking at a few major power plays. First, how a single speech from Fed Chair Jerome Powell sent the S&P 500 soaring and what it reveals about the AI algorithms now driving the market. Then, we'll turn to a different kind of power struggle as JPMorgan and Goldman Sachs lobby to strip states of their regulatory power. And finally, we'll dive into the retail world, where a deep divide is forming. We're talking sold-out luxury handbags on one side and dire warnings from the CEO of Crocs on the other. The S&P 500 just surged 1.5%, and it all comes down to a speech from Federal Reserve Chair Jerome Powell that sent shockwaves through the markets. So why the huge reaction? It's because lower interest rates act like a turbocharger for the high-growth tech stocks that dominate the S&P 500. Their value is based on profits expected far in the future, and when interest rates are low, those future profits are worth much more in today's money. Research actually shows that since 2020, almost 90% of the movement in software company valuations can be explained by interest rates alone. Powell just gave what's been called a rocket boost to expectations for a September interest rate cut. What's fascinating, though, is that he's signaling this cut even while admitting the effects of tariffs on consumer prices are now clearly visible. And when we say the market reacted, it's crucial to understand we're not just talking about human traders anymore. We're talking about high-speed AI algorithms that scan Powell's every word in milliseconds. Federal Reserve Vice Chair Philip Jefferson has even warned about this, noting these systems prioritize speed over accuracy, which can lead to massive and sometimes mistaken market swings based on a single phrase. This sets up a massive conflict at the heart of the US economy. In his own words, Powell described it as a challenging situation with risks to inflation tilted to the upside and risks to employment tilted to the downside. The Fed is making a high-stakes bet, arguing there's a reasonable case that this inflation will be relatively short-lived. But if that bet is wrong, the consequences could be severe. However, if you zoom out, you'll see another layer of strategy at play. This decision comes after months of intense political pressure and public criticism from former President Trump, who has been demanding rate cuts and has openly called for Powell's removal. The reason this dynamic is so different now is that the rise of social media has fundamentally changed the game for the Fed. In the past, this kind of pressure was mostly behind closed doors. Now, it's public and instant. Researchers even created the Vol-FIF index to measure how political tweets can directly cause market volatility, showing a statistically significant impact. In a direct response, Powell stated that policy is not on a preset course and that decisions will be made based solely on their assessment of the data. He added, "We will never deviate from that approach." And when Powell says data, he means it. The Fed relies on massive economic models and a system called FRED that holds over 800,000 different economic data streams. They're even using AI and machine learning to analyze conflicting signals, trying to find patterns that older models might miss. So when he says it's data-driven, he's talking about a serious technological operation. The market heard a green light, with one chief economist saying the Fed opted against being the party pooper, but others are sounding the alarm. An analyst at KPMG warns there is more caution than the markets are giving him credit for. So while one expert says a September cut looks almost nailed on, the Fed chair himself is pushing back against that certainty. The market has placed its bet. The question now is, in this battle between inflation and a slowing economy, who blinks first? Speaking of powerful institutions facing intense political pressure, the Federal Reserve isn't the only one in the hot seat. After Texas sideline giants like JPMorgan Chase, Bank of America, and Goldman Sachs from its bond market, America's largest banks are now launching a massive lobbying effort to make sure it never happens again. According to sources, these financial giants are petitioning the Office of the Comptroller of the Currency for a single national standard for banking. The goal is to create one set of federal rules that would override the power of individual states to penalise them. Interestingly enough, the regulator they're petitioning, the Office of the Comptroller of the Currency, or OCC, has its own institutional incentives to support them. You see, the OCC is funded by fees from the very national banks it supervises. By centralising regulatory power, The OCC not only streamlines the system, but also enhances its own authority and budget. The core of this conflict is a practice called debanking, where states punish banks over their internal policies on hot-button issues like guns, climate change, and diversity. On a technical level, this isn't about gut feelings. Banks use incredibly sophisticated algorithms and machine learning models to make what they call objective, risk-based decisions on who gets an account. But the challenge is separating that legitimate financial risk from political pressure. The OCC even tried to address this with a fair access rule, but that rule was paused, showing just how contentious this issue is. Lenders argue that a patchwork of rules from states like Florida, California, and Tennessee is creating compliance headaches. To give you a sense of the scale, this complexity has created a multi-billion-dollar regtech industry just to help banks navigate the maze of 50 different sets of state rules. A JPMorgan spokesperson stated plainly, "We support a national standard that expressly prohibits political or religious discrimination in banking. They argue they should be allowed to make their own lending decisions based on their business models. But state officials argue their oversight is essential. The risk here is that tangible consumer protections could disappear. For instance, states like California have enacted stronger laws like a student borrower bill of rights and a homeowner bill of rights to shield people from predatory practices. These specific state-level safeguards could be nullified under a weaker one-size-fits-all federal rule. And even if the banks win this fight, the war isn't over. States are already using other tools to influence bank behaviour. California, for instance, passed new laws requiring large companies to disclose their greenhouse gas emissions and climate-related financial risks, creating market pressure through transparency. This sets up a monumental power struggle. Emboldened by a recent US Supreme Court ruling that favoured federal law, the banking industry is pushing for consistency. The states are fighting to keep crucial consumer protections. The question now is, who will control the rules of money in America, the states or the banks themselves? From a battle over regulations to a battle over tariffs, the impact of government policy is being felt everywhere. The situation presents a fascinating duality in the retail sector. On one side, the CEO of Crocs is sounding the alarm, saying his customers are super cautious. His exact words, they're not purchasing, they're not even going to the stores, and we see traffic down. On the other side of that coin, Coach launches a new handbag for $695 Solzet, and it sells out within minutes. This reveals a sharp divide as retailers brace for the impact of tariffs. For some, the bill is adding up fast. Tapestry, the parent company of Coach, expects a $160 million hit to profits this year alone, but the retail giants are fighting back. Walmart, after previously warning of price hikes, is now absorbing costs in key areas. Home Depot is diversifying its supply chain, so no more than 10% of its imports come from any single country. And this isn't just about finding new factories on a map. To pull this off, retailers like Home Depot are deploying sophisticated supply chain management software and AI to rapidly vet new suppliers. But this is where the situation takes a more complex turn. The real story isn't just about dodging tariffs, it's about a fundamental business shift, especially at Walmart. Its global advertising business just exploded, growing 46%, and its third-party marketplace revenue is up 17%. Believe it or not, this is about Walmart transforming into a full-blown tech company. Experts call this a retail media network, and it's an absolute goldmine with profit margins as high as 70%. It's why Walmart recently spent over $2 billion to buy the smart TV company Vizio to get its advertising platform directly into millions of living rooms. This high-profit side business gives them a massive cushion to absorb costs. The company is signaling a new reality. We are more than just a standard brick-and-mortar retail business. This creates a brutal landscape. Brands with loyal customers, like Birkenstock, are raising prices with no pushback. But as one analyst noted, if you're a struggling brand, your suppliers have far less incentive to help you absorb costs. Now, that pressure on brands has real unseen consequences down the line. When big retailers demand lower prices to offset tariffs, it's often the smaller international manufacturers who get squeezed. They might be forced to cut corners on product quality, or even worse, it can lead to compromised labour practices. This all begs the question, in a market this divided, who has the power to survive and who gets left behind?
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.